Welcome to another interesting episode. In the earlier presentation, we saw about the stock ratios, different ratios on the stock. And this time, we look at the mutual fund ratios. As you might be aware, mutual fund is something like you don't have a direct control. You have a fund manager who is supposed to be an expert, and he does the investment on behalf of you. And there is, he gets his remuneration through the expense ratio, which is charged to the investors. So how is that you can define the ratios, mutual fund ratios, to find out which is a better performing mutual fund? Because unlike stocks, where you can look at the various ratios like earnings per share, PE ratio, PB ratio, debt equity, it is specific for a company. Here it is group of companies. So it's always difficult, but there are certain about two or three which you can look out for the ratio. So that's what we are going to look at. It's called the XIRR with versus CAGR. XIRR stands for Extended Internal Rate of Return. Rate of return is a direct one. It's a percentage of interest. How much is maybe 6% rate of return? Seven. If you look at, say for example, fixed deposits, it's about 6 to 8%. Whereas in case of mutual fund, something like you could invest something like SIP investment, maybe monthly basis you invest on something, and then finally you take out the funds. So in that case, how do you determine the rate of interest? That's where the extended internal rate of returns. You can look at the spreadsheet which gives you that. So you don't need to really have calculate on your own. It is available in the spreadsheet. So why unnecessarily look out or memorize the formulas? We'll see that as well. So as far as the mutual funds are concerned, particularly if you're going to be doing some kind of a SIP investment, systemic investment plan, then probably you can use the look out for the XIRR ratio and look out how the mutual funds are working. CAGR is a straightforward one. Particularly, it looks out cumulative return on investment into an annualized average. So this is ideally annualized compound annual growth is something like say fixed deposits. Yes, then you deposit some amount 5,000, and then yeah, you don't take it for 2 3 years. Then each year it is 6%. But then since the interest is again reinvested, you get a compounded annual interest rate. So CIGR is more common with the fixed deposit or lump sum investment in mutual funds. And XIRR, the extended internal rate of return, is when you do a systemic investment plan, you invest on a monthly basis, or even otherwise, you're going to invest some amount on a monthly basis or a time basis. Need not be on a monthly basis. First month you do a lump sum, and third month you do another lump sum. But after a few years, you take it. Then you can calculate the XIRR ratio and see that it is check how it is performing. So it's all possible with the spreadsheet itself. We'll see that as well. So CIRR ratio is one ratio as far as the mutual fund is concerned. So you need to look out how it is performing, particularly if you are investing after few years after the mutual fund is in place. Based on the net asset value, you check the XIRR ratio. The other one is expense ratio. Generally, as I said, on behalf of you, it is the asset management company involving the fund manager who invests on your behalf. There are going to be expenses involved for them, payment of salary. They have asset management company. Of course, they have their own staff, their own building, their own. It's a kind of almost a separate legal entity on its own. So there are going to be expense involved. So in that case, you need to look out for the expense ratio of that particular fund. Generally, yes, anything considered from 1 to 2.5 is what is generally happens in any of the mutual fund. So it's said to be okay. Anything less is good, but you'll always find in the range of 1 to 2.5 or 2.7. And what is interesting is that you need to two plans now. There is a direct and regular plan. If it is through the brokerage firms, then it is always a regular, and that's where the expense ratio gets increased as well. Whereas with the direct plan, it is directly to the AMC, to asset management company. In case of hires a broker and all the transaction are processed, purchase, sale of shares or mutual fund of that portfolio. So that's a regular plan, particularly if you are going through a third party or through some of the website, then yes, it's a regular plan. Whereas if it is directly to the asset management company, then they provide a this direct fund. So you need to apply through the asset management company, and there is, I would say that there is a difference of about somewhere the expense ratio is about difference of approximately 1%. So yeah, why do you leave that 1% appreciation? So better, yes, you can go for the direct plan rather than a regular plan. Only thing is, if you go for the regular plan, you can have them consolidated at one place, just like HDFC Sky or maybe Zerada, or you can have them in one place and invest in multiple mutual funds rather than focusing on one fund. Whereas if it is direct, only if you are going into the HDFC mutual fund, you can only invest on HDFC mutual fund alone. So that's a difference. But the point here is the expense ratio, you might take a look, but it's not a critical one. But XIRR is a critical one to know how is the fund performing over the period of time. Yes, anything right from 12% to 15% is supposed to be good as far as mutual funds return are concerned. That is the XIRR ratio of 12 to 15%. We'll also see how that gets calculated in a spreadsheet as well. So, open a spreadsheet. So, say for example, on 1st Jan, uh, that is on 2021, I invest about 5,000. So, only thing is during calculation of this XIRR ratio, because an outflow, you need to indicate with the fund outflow from you, you need to indicate with a minus sign as well. So 1st Jan, and then on 1st Jan 2022, I invest about 7,000 on the same mutual fund. Either way, like whatever method, lump sum, or you can be on a monthly basis as well. 1st Jan, then 1st Feb, 1st March of 2021, for 12 months you could do an investment. It's all up to you. And again, on say for example, first I'm going to say Feb of 24, I withdraw about say 16,000 is what I totally withdraw that mutual fund of 16,000. Now, if I want to calculate the XIRR ratio, how much is the internal rate of return of this amount? Then it gives you XIRR value here and dates. So the entire thing you need to include, then have a comma, and then the date values. Include the date values and close the parenthesis and then into 100. So that's for the percentage. So here it's about 12%. Yes, as I said, anything above around 12 to 15 for a mutual fund is good. And you can also see, suppose instead of 5,000, if it is that is 7,000, yes, it's very less. 5% is not even in the fixed deposit. Suppose if it is much lower, like 2,000, you'll see that the ratio is going up. So that way, this is particularly the XIRR ratio. The point here is particularly if you are making investment regularly on a monthly basis, then you can calculate the XIRR ratio and see how the fund performance on year-on-year basis, and then take a call. The returns are not good. Yes, you can switch to different funds. So, as I said, as far as the mutual funds are concerned, the XIRR ratio is one which generally people look at. Yes, the other ratio, CAGR, is for the fixed deposit, because that's a cumulative annualized return. It's not applicable particularly for not for that much for the mutual fund. There's a fixed investment. over a period of time, then its calculation of rate of internal rate of return is much more easier. That is one thing. Of course, the expense ratio is another one, but expense ratio has a catch. As I said, if you're going to do a direct investment on the asset management company, then yes, the expense ratio are less. That's a feature which has been introduced right in the year 2014 onwards. So you can depends on your comfort factor, because you need to go into the asset management company's website or go to them and then procure that specific mutual fund. If it is a different asset management company, then you need to go to that asset management company and procure. Whereas in case of a brokerage site, it can be in an all the same place. Only point is, yes, the expense ratios varies whether it is direct or regular. So I think you found this presentation useful. Thank you.